We've all seen the insane headlines in the Amazon aggregator space over the last couple years. Over $15 billion invested in the space. Multiple billion-dollar valuation unicorns like Thrasio. But what we haven't heard is the actual people investing this big amount of money in the aggregators. And in today's video, I have a one-on-one deep dive tell-all interview with one of the people pumping in over $500 million into Amazon aggregators. It is a doozy. Strap yourself in. Let's go. So I would like to say that all interviews are created equal, but I would probably be lying if that was the case, because I have been giddy like a kid waiting for Christmas to have Brian Harwitt on for this discussion to really deep dive into the aggregator space. I think that, we've seen all the headlines, we've seen all the stuff that's happened over the last 18 months. 15 billion plus injected into the space, 60 plus aggregators, and we've come to know a lot about how that world works. But one thing that a lot of people, myself included, haven't had insight into is the people actually investing in the aggregators, right? And so Brian Harwitt, who is a partner at CoVenture, is one of these leading credit and equity investors that's actually investing in the aggregators that are buying businesses. Between both credit and equity, which we'll get into the dynamics of that, they've invested north of $500 million into the space. They know the players, they see a layer of this business that I don't think a lot of people have access to. So with that, Brian, man, I'm super, super excited to get to know you, get to understand the CoVenture story, and most importantly, peel back the onion of this space and kind of your lens on it. If I didn't bastardize the intro enough, why don't I give you a chance to do your intro? But man, really excited to have you on.
Yeah, thanks so much. Excited to be here. We spent a lot of time in this space, and obviously being able to chat with you about this is awesome, and tell our story a bit more and reach a big audience like that. So, quick background on myself. I joined CoVenture about 5.5 years ago as employee number one. We had about $10 million of capital at that point. Now we're close to $2 billion. So it's been an awesome ride. And we've really focused on finding businesses that are providing financial services to new age businesses. So not like the corner stores and sort of pizza shops. It's like, let's figure out how to finance people that are being built off these platforms, whether it's YouTube or Amazon, Spotify, Airbnb, whatever it is. Like, these are businesses that have existed, and we're really focused on financing companies that are in those platform-based economies. We've been around for about that time and have really scaled and focused on those types of platform economy businesses. And over the past 3 or so years, we started to pay a lot more attention to the Amazon ecosystem. And it became clear that these businesses, Amazon third-party seller businesses, which we've talked about, I'm sure, a lot before, is like $300 billion plus in annualized revenue. We assume that there's $50+ billion of profits being generated from these businesses. Like, this is a pretty ignored asset class. Not a lot of financial infrastructure there. Not a lot of sort of private equity or venture capital dollars flowing into the space. And so Thrasio was really sort of the first instance of people really paying attention and focusing on the space. So we had looked at Thrasio and unfortunately passed a handful of times, but over time started to see more and more people, approaching this space, talking about the opportunity, where we felt like it, was ready for institutional capital to enter. And so we made that first investment about 2 years ago at this point, at the beginning of 2020, in a company called Aggregator, who we've been working with, and got really excited about the idea of you can buy these assets at relatively low cash flow multiples compared to other areas in the private equity ecosystem, and then utilize a playbook from Amazon experts to improve those businesses and grow them over time. And so I think like that got us really excited. And from there, we said, all right, this is such a big market that not only can we back one operator, is we can also back a basket of operators. And this goes across both the credit and the equity sides of the businesses. And so it's been a really exciting thesis thus far. We back 5 different people on the credit side of the business, and then 10 plus on the equity side of the business. So it's been great, and we've learned a lot along the way. I've really enjoyed digging deep in this ecosystem.
Cool, and we'll get into the whole like credit equity dynamics just to kind of like peel the onion back on that. But I was just curious. I think like the first time I had heard of the Thrasio story, I was probably about a year or so into building my first Amazon business, and it was like I'd heard about this thing, and before then there was like empire flippers and like all these like website closers, and it was 2x multiples. It really wasn't seen as a exitable asset class, at least at that time. And like Thrasio kind of early early days, you heard about them. They were like the first on the scene. And it literally felt like in a 6-month period, it went from Thrasio to like 50 plus players and like 7 billion plus in that time. For people that don't understand how these markets work, because I really feel like high street finance, like there's a couple blocks in Manhattan that like, it's like a cloaked world that everybody in that like ecosystem understands the dynamics, but everybody outside of it doesn't. How does that happen where you go from one player that's kind of quietly pulling things together to all of a sudden 7 billion plus, 50 plus aggregators coming in the space? Like, do you guys all talk to each other at the bar, or like help people understand how this thing unravels so quickly and how everybody jumps in?
So it's really interesting. Thrasio did a funny thing where they did a press release being like, this was so easy. We built this massive company and all this EBITDA, and like, look how awesome we are. And so every business school student across the country was like, wait, this is a great idea. Why don't we do the exact same thing? And so like you have the business school students, so like, you know, kids at Harvard and Stanford and Columbia, wherever else, they started like in their entrepreneurship circles, started thinking about starting these businesses. And then you have the Amazon native operators. So the folks like yourself who said, well, I've been able to start and sell businesses before. Why don't I take that expertise and try to build $1 billion business versus trying to build a $10 million business and sell that and sort of rinse and repeat each time over and over again. And so it became very clear that the opportunity, as how Thrasio was able to build the business and how quickly they went from $0 of revenue and valuation to $1 billion of valuation, how quickly people saw that opportunity and they said, well, I can do this too. Right. I can take advantage of it. And the market size is so big that it can accommodate multiple winners and that it's not a winner take all market.
Okay.
So that was the dynamic that really played out there, in the same way that entrepreneurs were having this sort of like FOMO. Investors were too. And it's like there were all these, you know, great investors that made a lot of money early on in Thrasio. And they said, well, why don't we just rinse and repeat, find operators that we're really excited about and start backing them and trying to sort of have a similar type of outcome. And that's when all these businesses started. So you have like this sort of the supply of businesses coming from people being excited about the enterprise value creation that they saw in Thrasio and how quickly that was done. And then you have the investor appetite, which is, okay, we saw how quickly this business was building enterprise value. We should start building, you know, investing in these businesses early, trying to build more and more of them and see how quickly we can create that value in the same way Thrasio did.
Got it. That's cool. Yeah. And it's almost like this like domino, like no one wants to be the first, no one wants to be the last. But like when that first domino tips over, it's like a flurry. But, you know, honestly, truly one of the most interesting dynamics I've ever seen in my business career, just how quickly everything unfolded. And it's super fascinating to be kind of in the middle of the hurricane, so to speak. I don't think we've talked about, you know, throwing out credit, we've thrown out equity. Everyone's seen the headlines, which seem to be every 2-3 days now. XYZ raised 50 million. These guys raised 150 million. These guys raised 200 million. These guys were like, us in the space, we're kind of getting numb to it. It was pretty cool initially when you're like, holy shit, that's a lot of money. But now it literally is like, it feels almost like monopoly money at this point. So help me and us in the ecosystem understand credit facilities, understand equity, and understand the dynamics of those headlines. Where is that money coming from? How does it work as it gets deployed into the aggregators? I think people understand now how the aggregators work and the multiples that they play, how they buy businesses. But that layer above, I think, is still pretty opaque for most people. So help us understand that credit equity split and where the aggregator is getting their money and how does that all play out?
I would say anytime you see capital being raised into an aggregator, you should assume 80+% of it is going to be debt. And the reason that's the case is that most of the capital that's being raised for these aggregator businesses is related to acquiring new assets. One of the things that makes building these businesses so attractive and how Thrasio grew so quickly was that they had debt that was allowing them to finance 100% of the transactions. And so from the equities perspective, all you really have to do is put up enough capital to hire people at the corporation. So you got to hire your brand managers, you got to hire a supply chain team, you got to hire your C-suite, whatever else it is. And so the rest of the capital that's going into actually acquiring the assets was debt. In most other instances, I would say, depending on the debt arrangement, there's anywhere between 70 and 100% of each transaction that's happening is going to be financed by debt, which means that you're actually able to use a lot of debt, and the amount of equity you have to raise, meaning the amount of dilution you have to take as a company, selling stock that, you know, lowering your overall ownership of the business is relatively less in this sort of business. Now, people are raising equity to do a couple things. One is to support the purchase price. So let's say they're only getting 80% of the transaction price from their debt provider. So they have to raise money to actually put into new transactions. they'll raise money to have a little bit of a margin of safety if things are to go wrong in their portfolio. They can help put cash into cure any issues or acquire more assets. Because the thing about raising debt is there's covenants. And so if you are acquiring assets and those assets start to struggle, which is what we've seen a lot across the ecosystem, given the COVID pull forward in demand, you have to figure out ways of satisfying those covenants. And so oftentimes raising additional cash as a means of protecting the debt covenants is a way of doing that. So that's another use of equity proceeds, as well as hiring, making other acquisitions. Like we saw Thrasio has been focusing on affiliate businesses and ways of improving their advertising efficiency. So, people will raise additional equity on that end of the business. But I would think about the split between, corporate hiring and supporting transaction purchase prices from the equity perspective, and on the debt side, purely focused on financing the acquisitions that the aggregators are carrying out.
I mean, most laymen, they understand the stock market to a certain degree, at least surface level, and they maybe understand venture capital, which is like the folks that invest in software companies, which is traditionally primarily equity heavy, where they're giving a portion of the business, and they're high cash, high margin businesses that they then scale that way. But these are pretty asset intensive, inventory intensive businesses. So in terms of the split between the two, obviously a lot of people have levered debt significantly to buy these assets. What is when you guys are investing, or your counterparts that are investing this, 15 billion plus into this space, what percentage do you require equity be part of it versus debt? Just to understand how much of the money is being thrown around.
So I would say it really depends on the company, and it depends on, I'll try to avoid getting too technical, but there's a couple levers here. So it's going to be hard to not be too technical. So there's this thing called like loan to value or advance rate. And what that means is like, what percentage of the transaction considerations are we willing to advance against? So let's say there's $100 for the business, $20 for the inventory. If we're advancing 100%, obviously we do the whole 120, and then you can just multiply that by whatever the advance rate is to see how much the lender has to put up versus how much the underlying borrower puts up. The other throttle in it is the most common covenant you see across this is what's called the debt to EBITDA ratio. And so these businesses that they're acquiring are all generating some levels of EBITDA, mostly focused on brand level EBITDA. So really just focused on, if you were to have, SDE, as I guess most sellers are thinking about it, those covenants range anywhere from 3 to 5 times, could be higher than that, just depending on where the market moves. And so that's the other limiter. So if you're buying a business for 5 times and your covenant is at 3.5 times, you actually have to put up 1.5 times in your equity. You have these two levers, and they're both essentially governors on purchase price of what percentage has to come from your debt and what percentage has to come from your equity. So it just depends how expensive the multiple is, and then whatever the agreed upon percentage of purchase price that the lender is putting out. So I'm giving you a little bit of a wishy-washy answer, but yeah. I would say anywhere between 70 to 100%, depending on those two ratios.
Cool. And what are some other core covenants? And again, covenants, for people that don't know, they're basically rules, right? Like there's no free lunches in life. So you guys give, when you give somebody $100 million, it's not just go have fun at them with $100 million. We'll check in a couple of years and see how you did.
Yeah.
There's yardsticks and kind of goalposts that keep people risk mitigated with how that capital is deployed. So debt ratio is one. What are some other handcuffs, so to speak, on the money that you guys have in terms of covenants that people need to uphold as an aggregator?
It's a great question. I think you stated it well for simplifying it. Essentially, it's everything is good so long as you're following the rules, and if you're not following the rules, we have to have conversations, right? So the covenants are the start of those conversations. The debt to EBITDA, I'd say, is the most critical. The other things are around like use of proceeds. You can only use this debt capital to buy businesses and inventory. That's typical standard. There's also liquidity covenants, which mean how much cash do the underlying aggregators have on their balance sheet to make sure that they have enough money to continue operating their business. And so making sure that you don't have $500 million loan to someone and then they only have like $2 million of cash in their bank account. Like that's not something that we would want. So we want to make sure that there's sufficient cash that the underlying borrowers are having. There's something called the debt service coverage ratio. That means like how much EBITDA are you generating relative to your interest expense. So every month they have to pay interest. And so how much excess margin do they have as it relates to the EBITDA they're generating versus the interest they're owing out on that? There's other covenants in play that could cause people to trip up. For example, if a listing is, or a ASIN is delisted or a merchant is delisted, that might cause issues, regulatory issues that Amazon could carry out, or the US government could carry out if it's illegal to have, those be businesses. But those are the core covenants that we focus on. And I think that most other lenders are going to be focused on.
Okay. Really cool. I appreciate you shedding light on that. So, all right, well, let's turn the page because I want to kind of talk about what happens when things do get off the rails a little bit and how that plays out. But are you familiar with the Minsky boom and bust cycles?
No.
Okay. It's this concept, and it's really traditionally around equity markets, equity and bond markets. But basically, like in the 1980s, when the first quant guys got into bond trading, there was these massive 100 basis point opportunities because they arbitraged it. They got in early and first. They made bets early and they made massive opportunities. And then as people start to see those outsized returns, more people enter the space, more institutional money enters the space. The markets get de-risked because there's way more information accessible and people start to see how the returns play out.
Yep.
But the opportunity on the basis point growth kind of shrinks a little bit. And it gets to a point where you make a lot of money in the early days. In the middle point, you make a lot of money. But as it gets towards kind of peak, so to speak, it seems like it's de-risked, because there's so many people enter the space. There's so much smart money. But there's a pendulum swing where it actually becomes more risky because the return reward kind of balance gets out of whack. And so in the boom cycles, it's more capital gets invested in the market that leads to higher returns. There's way better risk adjusted performance. The market appears really attractive, so more money enters the space, and it's a cycle almost like an Amazon flywheel effect in financial markets.
Yeah.
But there's a point where it potentially goes the other way. So people don't get their risk-adjusted returns that they thought they were going to get. Covenants get broken. The well starts to get poisoned, so to speak. Money comes back. It's harder to raise equity rounds at the same valuation as before. And the opposite happens, and the market gets soured pretty quickly. I'm going to paint a picture, some of which I believe in. I think there's some truth to this, some not. But here's one thesis that you could say we're in a Minsky bust with the aggregator space. So, Thrasio, call it 3-4 years ago, got in, was buying these companies for between 2 and 3 times multiples. Yep. They were from these operators that didn't necessarily have a ton of sophistication, but had built these really cool businesses, up to $5-10 million. They get in there with really bad listing images. They reskin it. They, add 10% to their conversion rates. The category's growing. Amazon's growing. They're maintaining the bestseller badges. They're able to hold rank and, maybe spend a little bit more money in advertising, get economies of scale, and everything's amazing, right? And that's where you get these insane, right-sized kind of valuations. Dynamics over the last year, though, right? So you get, these guys that, came from Harvard or came from Goldman Sachs. They're like, hey, this is amazing. This is like financial arbitrage. Let's get in here and do this. Well, they realize, maybe COVID comps is difficult because you had a really influx of performance that maybe is hard to replicate. You've got supply chain challenges that cause out of stock risks, which causes a cascade of challenges for losing rank and losing the earnings that accumulate. And then you've got ad positions where before maybe there was 4 sponsored brand ads on an organic ranking page. And if you had spot 1 to 4, you were killing it. Now, if you're in spot 5, you might be in the middle of the page because of the ad dynamics that have played out. Add on top of that, you take a solo entrepreneur that was running an Amazon business with maybe a couple of VAs, and now you've injected, 8% OpEx to build out these teams that hopefully give you more bodies to kind of turn earnings and cash flow. But that doesn't always play out. And so now you've got a situation with a lot of these folks that are facing those dynamics, and they maybe raise money in the peak where they were getting 10x 15x kind of valuations, thinking that they might have a SPAC or go public, whatever else, and now they've got to do a down round, which in venture capital, a down round is like a kiss of death, right? Because you can't hire people anymore. People don't want to inject money. You break covenants. People don't want to give you debt. And in a business where you're growing inorganically, primarily through acquisitions, things get messy quick. I said a lot there, and again, some of that I believe in, some of that I don't. Some people I think will absolutely fall victim to that, some won't. But with that landscape, which I think is much a narrative that's a lot easier to believe now than it was maybe 6-12 months ago when a lot of people got into the space, help me and folks understand your perspective at the 30,000 foot view that you see the world, how you see that playing out.
I mean, you painted a very good bear case of this is in all seriousness, I was like that, word for word, if I was to tell you why not to invest in the ecosystem, that's what I would say. And I think there's elements of that are very, very true. And I would say like the key components that we saw that were really challenging were sort of threefold. Is like, one, you had multiples going up because the influx of capital into the space was driving these businesses from 2 to 3 times or 3 to 4, whatever it was, to now you have assets that are trading, over 5 times and even 6 times, depending on the size and the EBITDA, and private equity starting to poke around. And so you've created this, increase in multiples. In tandem with that, you've had a pullback of demand from consumers. And so COVID bump, which increased sales 40%, EBITDA 40%, in addition to the margins being healthier because of, like you were mentioning, there was less, paid slots in search. And so essentially from Q2 of 2021 onward, you had this like cratering of demand and challenges from a margin compression on Amazon's ecosystem. Those were challenging times. And I think that was a really difficult moment in time for sort of these Amazon sellers. And in addition to that, you also had the supply chain. This is the third piece, which is the supply chain was completely, screwed up. And I think it was hard to, even if you could get your goods from China, like good luck getting them to the port, good luck getting them to the 3PL, good luck getting them from the 3PL and Amazon to actually take them up in time, because like you were seeing stockouts left and right. And like no one was really doing merchant fulfilled Prime, because like that, no one really believes in that being a sustainable model. And so you had all of these things that came together all at once and provided pretty big challenges. And so like aggregators that were buying at 5 times for businesses that had clear pull forwards and demand from COVID, those blew out to 8 times, 10 times. And so what we were really focusing on when we were backing our players in the space was, do you have extreme experience operating on Amazon? Do you understand the ecosystem? Do you understand supply chain? Do you understand inventory planning and everything along those lines? Because those are table stakes. And I think a lot of what we saw when new aggregators were coming into the space was that they lacked a lot of that experience and thought that the most important thing was buying businesses and not actually running them. Because that's what they thought in Thrasio. They're like, all right, we can inorganically grow and build $1 billion business. We don't have to worry about what the business do afterwards. And so I think what we're starting to see is like, actually you do. And that's really important. I think like a lot of the businesses that we back are run by people that have 5+ years of operating experience in the Amazon ecosystem, or have acqui-hired or hired people who have that level of experience and make that core to their team. And so I think like my viewpoint is, for the companies that were acquiring responsibly and being careful about the assets and the multiples that they were paying, they're going to be okay. I mean, their portfolio is still hurting. It's not perfect, but overall they're able to maintain, sufficient enough leverage, because even if you were buying these assets at 2.5 times and they went down 40%, you're still within your 4 times debt to EBITDA ratio, going back to that sort of earlier point.
Yep.
And so I think what we'll have to see in the next 12 months is what happens Q2 onward, because Q2 2021 is where things started to soften. And if we don't see improvement Q2 2022 onward, that's where we're going to know there's a bit more problematic nature to the space, because then, is there any opportunity for organic growth, or are these wasting assets? And I think the things that you were mentioning before are really critical, which is Amazon's putting more and more ad slots into the search. We all know that no one's really buying anything off of the second page of Amazon searches. And so now you've pushed more and more listings from the first page to the second page. And so you're creating fewer opportunities, and the top ranking organic ones have to spend more money on search, on promoted search and PPC, because they know that they have to still be in that top range, even if they have 100,000 reviews and a 4.5 star visual star rating, because they need that moat. So that piece is really challenging. Staying in stock is really challenging. I think everything going on in Russia and Ukraine only complicates the supply chain. I think that, there's all sorts of things going on in China, potential COVID lockdowns there. There were power outages. Like it's almost like the 12 plagues are going on in the Amazon ecosystem, right? Like you have all these things happening at once. And so it's really amazing how resilient some of these businesses have been. And a lot of that is testament to their experience operating the Amazon ecosystem. And we haven't even touched upon like Amazon terms of service stuff, takedowns for patent trolls and takedowns for, products, safety issues that are obviously just, your competitors attacking you. So I think that we're seeing a lot of resilience from those who have significant operating history and those who raised a war chest, not only on the debt side of things, but on the equity side of things to weather the storm, knowing that getting through Q1 of this year was going to be challenging and focusing on Q2 onward to show real organic growth and inorganic growth from that point forward.
Cool. Yeah, that's a great answer. And trust me, at the end of this, we're going to get into like positive stuff because I do think you've got a lot of value to add to people. But I do want to kind of hit on one point because I don't think that even I personally completely understand how the dynamics play out. But like to use like a layman's example, let's say I've gone and gotten a car lease or I've bought a car on credit. Yeah. And my payment's $400 a month and I don't pay for a month. Okay, well, I might get a couple calls from the financing facility at the company I got my car loan from. 2 months goes by, I might get a letter, 3 months goes by, they might be like, Adam, literally, if you don't pay your car lease, we're going to come repo your car. And then at some point, they either turn over that debt to somebody that goes and chases it down, or they come and repo your car to get the asset back.
That's right.
Play out for me the dynamics of debt covenants being broken and how that plays out in reality. Like, it's not like on month one, they break their covenants and you're going to come and like get all their businesses back and the aggregator's done. There's obviously a dialogue that happens. There's a conversation about why they were broken. How do we need to, negotiate and flex on some of these for some period of time. But like somebody isn't meeting their covenants. Walk me through how that plays out. And when does the ultimate rubber hit the road where there is the repo moment from CoVenture to who you've invested in?
It's a great question. And I think it's something that we spend a lot of time discussing internally. So I think our primary goal is to get ahead of this ever happening. If we were to see any deterioration in any of our portfolios, if we were to see any negative signaling, we would typically talk to the company before the issue really starts to manifest itself and go to them and say, hey, you should start thinking about raising more equity, or you should stop focusing on acquiring businesses and focusing on organic growth. Retool your M&A group to your supply chain, whatever it is. I think like that's our first conversation we have. So it's like, all right, let's figure out how to prevent this, this iceberg from melting or whatever it is. Once a trigger is breached, we look at our outs, which is, does the company have the ability to raise additional equity, which is the typical solve? Is the company able to pay down some of the debt? Is the company able to grow these businesses organically? And how bad is the covenant breach that has come into play? Is it like a marginal breach, or is it something where we feel like it's pretty substantial? So we're looking from that perspective. For example, if they don't make an interest payment, that's very different than if their debt to EBITDA covenant goes over by 0.1, right? So like that, those are like the weighting in which we treat those covenants is very different. And one of the things that's an important dynamic that I want to point out in your example, like most loans in the Amazon ecosystem for the aggregators are interest only for a big period of time, and then there might be some amortization. And interest only means you're only paying an interest on your loan balance. So it's not like a mortgage where every month you have principal and interest being paid down. This is only interest, and then after a certain point you start to have to pay it down. And so the monthly payments are significantly lower than if you were also paying back the principal of the loan itself on a monthly basis. And so it creates a little bit easier there. So now let's fast forward, and like all of this is hypothetical. And let's say that we're in a situation where the portfolio is really struggling. What we would likely do is work with the company to find a home for the assets. That's one of the benefits of us having relationships across the ecosystem. We talked to 50 plus different aggregators as they were raising capital. We have a portfolio of different businesses where we say, you should start having a strategic conversation with portfolio company Y. And that is, is there a merger opportunity? Should we fold those brands into the other business that has had a better time operating those brands? That's our preference. We want to make sure that we're being good partners. And like, this is a hard time if you're struggling with sort of the debt in the businesses. Most of our operators are collaborative, and I think would want to participate in that rather than having to go to a legal showdown, which no one wants, all the wasted money on legal fees and everything along those lines. And so trying to figure out like what's the best outcome for both parties. And as things escalate, taking incrementally more strategic measures along the way. A big part of our thesis, why we originally did not back Thrasio, was there's no natural place for those assets if there was to be an issue as an operating perspective. As we saw more and more aggregators come into the space, the worst case scenario is you try to sell those assets off into market, or you fold them into another one of your portfolio companies. And so that's what is our sort of our parachute and our worst case scenario in our mind as to help if there's an issue with the covenants.
Got it. No, that's super insightful. And then in terms of like you kind of mentioned the Thrasio one, how critical is it that these, call it top tier, larger assets exit to equity? Like go public, go SPAC, like
Right.
roll up into a Procter and Gamble. Like how important is an exit event at that level for the thesis to play out? Or is it like, hey, look, that's an ideal outcome because it gives us at least a baseline barometer on what the true asset value is on these things at the equity level? Or is it more like, hey, we can run this thing, the debt, everything works even if nothing exits? But I'm just curious how much that plays out to, because it seems like there's been some stalling on some of these bigger asset classes going public.
Yeah, it's a good question. You give me some tough ones here. I would say like my view
You're
on
like,
it.
dude, man, this is supposed to be like an Amazon Smuck YouTube channel, not like
No,
a
it's great.
class.
I love it's awesome because it's clear you understand sort of both sides of the trade here. I would say if you like, it's good they didn't go public 5 months ago because equity capital markets have just been real rocky for companies, especially tech-enabled businesses. We can argue whether or not Thrasio is a tech-enabled business. I think there's some tech there. Had it gone public, we would have likely seen a correction, the price of that. Pretty far down. And so then all of a sudden you're comping down the rest of the assets that are raising privately. Like Aterian is public. I don't think people are paying that close attention to that business from a comps perspective. Just to be completely honest, I think people are focused on what's more happening in private markets. No offense to them. It's just sort of reality.
Yeah, I get it.
And so we have a situation in which Thrasio is being private as the market leader. And like, here is our gold standard for the debt to EBITDA, or sorry, the EBITDA, EV to EBITDA ratio that people are funding at, is probably good for the time being until there's stability in equity capital markets on the public side. But we want to see more and more positive equity outcomes because that allows our folks to be raising at those same levels from equity capital markets. And so from the equity side, that's really helpful for marking up the assets. And on the debt side, it makes equity capital markets easier, which provides us a margin of safety or something were to go wrong with the assets or the underlying debt. So eventually we're going to want to see some prints on sales or IPOs that have stable outcomes afterwards. But in this equity capital markets from a publicly traded perspective, I think we're okay with things staying private. But if some things do print for acquisitions at certain multiples, that would likely be helpful.
Yeah, that's awesome. All right, man. Well, enough doom and gloom. But honestly, I just think that understanding those dynamics, I think people are doom and gloom because they want the headline stuff, but understanding how the mechanics actually play out, I think is incredibly important. Yeah. And man, you're super eloquent in being able to kind of piece that together for people. So thank you for doing that. And man, what a time to be alive. What are the chances? Like 10 years ago, this kind of conversation would never have happened publicly. Oh, yeah. So I appreciate the transparency, and this is super cool. All right, so let's talk about how to build a absolutely kick-ass Amazon asset. You've seen the best aggregators in the space that know how to operate, know how to scale, know how to make the math work, know how to come out the other side, given all those dynamics. And there's always going to be ups and downs in anything that you chase after. Let's share some wisdom for the folks. You've been in the space at least a handful of years now. What are the elements that you think make a really good Amazon operator and a really good Amazon business?
Yeah. So I'm going to take this from the aggregator perspective, right? Because that's, I think, where I have the most understanding. So I like to think about, and I can thank a couple people in our portfolio companies who helped me like think about it in this way. And I'd always thought about it being a three-pronged approach to building a team for this space. And it's a multiplication function. It's not an addition function. So just think about this. So you have like the Amazon native operator who gets Amazon through and through. So that means they understand PPC. They understand how to escalate to Amazon as it relates to any TOS violations. They know how it is to defend a listing from an ASIN attack. They know what it looks like when competitors are doing things that are black hat, and they know sort of the gray areas to operate within Amazon. That Amazon expert is necessary to actually succeed on Amazon, just like full stop. Yeah. The second leg of that, and you could argue some people sort of have both of this, is just a supply chain expert. And so the supply chain expert is going to be doing a couple things, which is sourcing product, finding and improving COGS, improvements, whether it's going out to broker relationships or having existing supplier relationships. So we've seen it pretty well within some of our portfolio companies. On the aggregation side, it's like, hey, we have a lot of relationships in rubber. Like we can acquire more businesses in rubber, improve COGS 10%, and like that'll be an immediate EBITDA pull through, things along those lines. But there's also how do you efficiently send pallets to the US? Because I think a lot of issues are, all right, well, the cost of containers has gone up like 10x, something ridiculous. How do we make sure that we're making it most efficiently sending goods from China, wherever you're getting the goods, to the US? And so that's really important. And the other thing is, how are you doing your inventory planning? Because inventory planning also correlates to what are your freight costs? Are you having to do air shipping, which is obviously way more expensive? So I'd say like supply chain and importantly also inventory planning within that is really, really important because stockouts are, I would say like within what I've seen, stockouts have been the number one issue in the last year outside of just general consumer demand on Amazon. Like stockouts have been just really, really challenging for a lot of businesses. We even saw businesses, fortunately our portfolio has planned it out well, but Q4, people were like, we're not even going to bother to try to stock in on this because we just can't get product. That's the second sort of leg of the stool, is that supply chain expert, someone who can really manage that. And then the third piece is someone who's focused on acquisitions, M&A, due diligence, and integration. You can really lose on not understanding the businesses that you're buying. And I think you need sort of 1 and 2, the supply chain and the Amazon expert, to help you with 3. Like, how do you identify black hat tactics? Are you searching the PayPal accounts for free giveaways and promotions? Are you looking for Facebook groups where people are giving away product in exchange for reviews that are outside of sort of the buy and review program? Are you seeing things on there? Are you looking at the ratings and reviews to see, voice crack there, in a while, ratings and reviews to make sure that things look okay and that there's no suspicious like high instances of video reviews relative to what you typically see, or there's not a high instances of people saying the same things, or things where, are you sure they're reviewing that same product, or a cluster of reviews around the same date? And so like identifying black hat and gray hat tactics, ordering the goods to see, hey, are their inserts terms of service compliant? Are they soliciting reviews in exchange for money at the end? So like that's the thing we do. Like every time we would back a new aggregator, we would order their products and be like, let's go through the review funnel, because we want to make sure that we know that they're operating within the terms of service, because that is just an easy way, slap on the wrist, your product gets taken down, and good luck dealing with Amazon if that's the issue. So we have that component of the acquisition, and then you also have like rebuilding the P&L. And so we like when people bring in a third party to like help do that. Centurica is obviously sort of like the biggest name. They've been around the longest for this. There's other people that we've seen people use, but like, are you having a third party rebuild the P&L? Are you looking at the shipping orders and the POs to make sure that you're coming to a landed cost of goods sold that validates what they're showing you? Because realistically, revenue and other costs should be pretty straightforward unless they're doing off Amazon advertising or free giveaways. And that's the only other thing that like from a financial due diligence perspective, you really have to look into. And then making sure that like you can actually execute on those transactions. Like, are you able to negotiate the asset purchase agreement? Are you able to find and source deals proprietarily versus just having to rely on broker channels? Because broker channels are much more expensive than if you were to go directly and proprietarily. And so I think like those are the 3 components. And within each, we could go in, for a long time on each of those. But I think that's the key to success. And then you need that, someone who's also that generally it's the acquisitions person who's like, I'm going to run capital markets. I'm going to make sure we have enough debt capacity to go out and buy assets. And I'm going to make sure we have enough equity to continue to hire and have that margin of safety if things were to go bad, that we have, enough capital on balance sheet. That's the high level what we look for. It's worked out really well for us thus far from the people that we've backed. And I think it's been really important. And as things shake out and as we see aggregation of the aggregators or consolidation of the aggregators, we'll probably see people who don't necessarily have all 3 pieces of those solved merge with people who are also missing. We might have someone who's really good at acquisitions, but they don't have the supply chain and Amazon expertise. And so like maybe they find someone who's got those other 2 things, but needs to slot someone in for acquisition. It'll be interesting to see how that shakes out over the next year.
Cool. Yeah, it makes a ton of sense. And obviously, there's not like a silver bullet to any of this. It's doing dozens and dozens of things right to kind of piece it together. But of the best operator that you've invested in, can you think of one like really novel, compelling thing that they've done to inject growth into the businesses that you're like, I don't see a lot of people talking about that, but these guys who have been killing it did X that people can learn from?
So I can't, unfortunately, because my rule with my guys, it's if 4 or 5 of you are doing it, I'll tell the 5th. But if 1 of 5 are doing it, I won't tell the other 4. And so like unfortunately I can't. I would say like it's one of those things that people, some of the publicly available things that some of our guys are doing, like AccuCo, they started offering a Tesla to people who were willing to provide referrals for Amazon businesses that they were buying. The Benetago guys were saying, we'll match your offer, and I had 250,000 to it. Like, there's some little novel things around the edges that we've seen, but from things that aren't publicly announced, unfortunately, I can't go into that.
That was the expected answer, but I had to ask and just see how disciplined you were. So congratulations on your discipline. Well, let's maybe cap it with one thing, kind of giving your thoughts. If you were, let's say somebody's exited to one of your aggregator kind of portfolio brands and they're wanting to go at it again. They've got a couple million in the bank and they're like, hey, I want to go at this again and just see if I can get another bite at the apple. How would you recommend that Joe Schmo solo Amazon seller start and build a brand today?
It's a great question. And I've thought a lot about this because part of me, when I started seeing this opportunity, was like, should I start doing this? Like, should I start putting an Amazon brand? And I was like, no, I think the professionalization of the ecosystem has made it such that it's harder and harder for someone who has no experience doing this to enter the space. I think that for someone who does have the experience of building these types of brands, there is still opportunity, but you really have to find, I'd say, like niches, hyper verticalize. So areas in which there's no clear professionalization yet, areas that are maybe slightly smaller that aggregators are paying less attention to. That's one way of going about it. The other way is like, hey, maybe you start on different geographies. Like, how do you, a lot of Amazon aggregators that we know are saying, how do we build Walmart? How do we build Mexico? How do we build Japan? How do we build Europe? And how can acquiring a new asset give strategic deployment into those verticals that would be the building blocks for the other businesses that they're managing to do the same thing? And so I think like making yourself attractive as an asset and specializing in a potential new market where those aggregators are looking to expand into. So that might be one idea. Like, I think that a lot of people are spending time on other online marketplaces right now, specifically in the US, but also internationally.
Dude, those are I 100% agree with both those points. And I think to get those outsized opportunities and kind of punch above your weight, you got to have some level of opaqueness. So whether it's like the market's not quite developed yet, people don't know much about Amazon Italy yet, whatever it is, I think that you got to kind of chase where there's a little bit of asymmetry in information. And that's where kind of the benefit's going to be. So I 100% agree with that. Well, dude, we'll cap it at that. I mean, I could talk to you for a couple hours about this stuff and kind of nerd out on it. But I think this is the first time I've ever heard people talk about some of those deeper level mechanics that exist, the tier above, the Amazon aggregators, again, kind of shedding light on what's talked about in a couple blocks in Manhattan to the masses via YouTube channel is super cool. And you're an amazing sport about it. Handled some challenging questions appropriately. And I'm still super excited to see how this thing unfolds over the years ahead. And you guys kind of being at the forefront of it, tip of the spear, it was super exciting to chat with you. And I really appreciate it. And I'm sure the Amazon community is going to be thankful as well.
Yeah, no, this has been really fun. And I appreciate the difficult questions because I think it's important to not have this like, head in the sky, like, oh, everything's great, because everything's not great, right? I think there are a lot of challenges with what's happening right now. But, our viewpoint as a firm is we're cautiously optimistic that sort of the back half of this year is going to be a really strong moment for a lot of these aggregators. So I appreciate the difficult questions and shedding some light on that.
Yeah, agreed, man. And I think like anything in life, it's like the polarization tends to get the attention. Like when this space first emerged, this is the best and most amazing business dynamic that's ever happened. And then you get a little bit of headwind on stuff and people are going to think the bottom's rolling out. And the truth is somewhere in the middle. And I think that you helped to articulate how things might be playing out in reality. And it was super insightful. So cheers, man. Thanks again for coming on. And excited to see how things play out over the next couple of years.
Yeah, appreciate it. Thanks so much.
Cool.